Today, we're doing an intense, deep dive into AppLovin's massive August 2026 earnings transcript. And wow, this one is fascinating. We're looking at a crazy paradox here, a company shattering financial records while simultaneously trading against some incredibly severe regulatory risks. Okay, let's dive into the metrics. If you're an experienced investor in high-growth tech stocks, you already know AppLovin has been an absolute roller coaster this year. This company is fundamentally transforming digital advertising. They're basically a core infrastructure utility for the whole mobile app economy now. But check out this number, 3.7. That is AppLovin's beta coefficient over the past 12 months. That's literally the highest in the entire Russell 1000 index. It means this stock is exceptionally volatile. I mean, we're talking wilder swings than high flyers like Supermicrocomputer or Coinbase. So, when AppLovin posted a massive 12% surge right after their August 2026 earnings release, for them, that was just another Tuesday. Actually, in 13 of the past 14 quarters, this stock has seen a double-digit percentage swing on its first trading day post-earnings. That extreme volatility is the perfect setup for us to figure out why Wall Street is so fiercely divided on what this company is actually worth. And right here is the engine driving that high-performance vehicle. In Q2 2026, AppLovin reported a staggering 84% adjusted EBITDA margin on $1.924 billion in quarterly revenue. That revenue, up an impressive 53% year over year. Net income more than doubled, and their free cash flow generation is just massive. These aren't just good numbers, they are Magnificent Seven-level fundamentals. They are pumping out so much cash, they've actually been able to heavily fund a whopping $3.3 billion share buyback program. But to really understand how they pulled this off, we need to pop the hood and look at their business model. To truly grasp their competitive advantage, we have to break down how AppLovin actually makes its money. It's basically divided into two main segments. Over on the one hand, you've got their legacy apps segment. This is their portfolio of first-party mobile games. But the real story, the absolute driver of their enterprise value, is the software platform. This includes app discovery for user acquisition, Max for ad mediation, and Adjust for analytics. AppLovin has successfully pulled off this massive pivot from being just a mobile game publisher to a wildly high-margin AI software powerhouse. Today, their owned games mostly just serve as a giant proprietary testing ground to validate their advertising algorithms. Now, what's crucial to understand here is that AppLovin doesn't charge a traditional take rate like a standard demand-side platform. Instead, they operate a massive spread business across 1.4 billion daily users. Publishers get paid based on ad impressions, but AppLovin, they get paid by the advertiser based on actual performance, like did the user actually install the app or make a purchase? The software layer acts like this highly efficient matchmaker, and AppLovin just pockets the difference. This exact structure is what lets them generate those jaw-dropping profit margins that regularly top 70% in this segment alone. Now, what's really interesting here is the secret sauce behind all that matchmaking. It's called Axon 2.0. Let's cut through the ad tech jargon for a second. Axon 2.0 is basically a real-time machine learning auction engine. While traditional ad networks just blast impressions out there and cross their fingers for clicks, AppLovin's AI processes millions of data points every single second to predict user behavior and maximize actual sales or installs. It's designed to find the exact right user at the exact right time, and this creates a massive competitive moat. Why? Because the AI is delivering provable, closed-loop return on investment for advertisers, right in the middle of an era where privacy rules have made traditional tracking nearly impossible. And that kicks off this incredibly powerful data flywheel effect. As more advertisers from diverse sectors hop onto the platform, Axon 2.0 starts ingesting all these new types of user behaviors and campaign goals. Think about it like this. That massive trove of data they've collected on how users play mobile games is now being cross-referenced to figure out who's going to buy a pair of shoes online. The models learn faster, they predict better, and conversion rates just increase across the board. Higher ROI naturally attracts even more advertising spend. Because this feedback loop compounds on itself, it becomes insanely difficult for sales-heavy rivals to replicate. I mean, AppLovin runs this entire global infrastructure with only about 400 core ad tech employees. It just goes to show their moat isn't built on a huge human sales force. It's built on pure algorithmic supremacy. The financial result of that ridiculously lean AI-driven structure is undeniable. Just look at their margin superiority. AppLovin boasts a 57.4% net margin, absolutely crushing tech giants like Meta at 30% and Apple at 27%.
When you combine that crazy margin with their revenue growth, they hit a Rule of 40 score of roughly 150 earlier this year. This right here is why the bulls are arguing the stock is a screaming buy. They see this AI growth machine practically printing free cash flow and devouring market share in a $350 billion global mobile advertising market. But look, as an experienced investor, you know no one just looks at the upside. A stock trading at high multiples with this kind of extreme volatility, it means we absolutely must examine the roadblocks threatening this AI engine. We have to figure out why the company's growth is slowing down in certain verticals and why it suffered those massive drawdowns earlier in 2026. We need to pivot our narrative for a minute, step back from Wall Street's tech optimism, and face the harsh regulatory and execution realities AppLovin is dealing with right now. Let's walk through the specific problems AppLovin is wrestling with in 2026. First up, the SEC fingerprinting probe. This isn't just a scary headline, it's an active structural threat. The SEC is investigating AppLovin's use of probabilistic matching. Basically, this is a method where algorithms predict who a user is by analyzing metadata, things like battery levels, IP addresses, and screen brightness, so they can totally bypass the need for a unique user ID. Regulators absolutely hate this because it essentially reconstructs user tracking without getting explicit opt-in consent. This regulatory overhang is a huge weight on the stock's PE multiple because if they're forced into structural changes, it could severely damage Axon's predictive power. Problem number 2, the highly anticipated self-serve e-commerce platform. Management confirmed on the Q2 call that this rollout got pushed back to the first half of 2026. Because of this delay, their Q3 e-commerce revenue growth is effectively flatlining. They're burning time in a crucial window when brands are allocating their Q4 holiday budgets, completely missing out on that critical retail revenue wave. And third, platform dependency, which honestly is probably their most existential threat. Which brings us to this absolutely crucial quote. Part of AppLovin's moat is rented. Think about it, AppLovin doesn't own the smartphones. They are entirely at the mercy of Apple's iOS and Google's Android policies. A single future privacy policy change from Apple or Google could literally cut off Axon's data supply overnight. Plus, they compete directly with Google, who controls the Play Store and has its own massive ad business. If the ecosystem pushes back, or if a new SDK-less competitor like CloudX really takes off, AppLovin's huge data advantage could just evaporate. So let's see how this builds into the ultimate valuation debate. Is AppLovin overvalued or is it undervalued? To really answer this, we can't just use the standard price to earnings or PE ratio. A high PE ratio almost always makes a high-growth stock look artificially expensive. Instead, we have to look at the PEG ratio. That's the price/earnings to growth ratio, which divides the PE by the company's expected earnings growth rate. Right now, AppLovin's PEG ratio is sitting comfortably under 1.5. That actually signals it might be deeply undervalued compared to ad tech peers like Unity Software. Unity is struggling with profitability and wrestling with super expensive structural reorganizations, driving their effective PEG much, much higher. Plus, if we zoom out to long-term US economic trends, there's this massive macro shift happening right now toward retail media networks and huge AI infrastructure buildouts. Brands are realizing they desperately need third-party AI ad networks to efficiently monetize audiences outside of walled gardens like Facebook or Google. If AppLovin successfully captures this shift, the bull case sees e-commerce adding an incremental $1.2 billion in revenue, potentially driving the stock towards $750. The bear case, though? It argues that if the US economy hits a macroeconomic downturn triggering broad ad budget cuts, or if that SEC probe forces fundamental changes to their data collection, well, this stock becomes a classic value trap. Looking ahead to a detailed forecast for 2027, AppLovin has a few massive catalysts that'll determine exactly which scenario plays out. First, management is launching a brand new tiered referral program. This isn't some cheap marketing gimmick. It mathematically accelerates the onboarding of large e-commerce advertisers by subsidizing their initial test campaigns. This lets hesitant consumer brands see Axon's return on investment basically risk-free. Second, they are heavily expanding into the rest of the world audience. They're specifically targeting emerging middle-class mobile markets in Latin America and Southeast Asia to dramatically boost their global average advertiser spend. And finally, despite those delays we talked about, the SME self-serve platform launching in early 2026 is expected to unlock massive retail media demand by 2027. It's going to allow mid-sized Shopify store owners to plug directly into Axon. If they execute all of this seamlessly, Bank of America forecasts AppLovin could reach $10 billion in revenue, scaling completely out of their old gaming silo. But in a negative scenario where the e-commerce transition stalls and competitors like Meta use their proprietary Advantage Plus algorithms to claw back iOS market share, AppLovin's revenue growth could severely decelerate, bringing their sky-high valuation crashing right back to historical norms.
So what should you take away from all this? Well, the ultimate litmus test for AppLovin over the next few quarters is all about margin resilience.
you need to watch closely to see if that 84% adjusted EBITDA margin actually holds up. Remember, AI engines like Axon require massive, incredibly expensive compute power. Not to mention, competitors like Unity are rolling out their own AI platforms like Vector. If AppLovin is forced to sacrifice its margins just to maintain market share against Unity, or if those AI compute costs suddenly outpace their revenue growth, that deep value discount we talked about, it might just be a total mirage. Which leaves us with this final provocative question. AppLovin has undeniably executed one of the greatest corporate pivots in tech history, going from a simple gaming publisher to an insanely high-margin AI powerhouse. But honestly, how far can this AI-driven performance machine actually scale into the broader global retail advertising market before the ecosystem, meaning the SEC, Apple, or Google, finally pushes back? This crazy paradox of hypergrowth versus rented infrastructure makes AppLovin one of the most fascinating, high-stakes stories in the market today. Before we wrap up, I just want to leave you with a really important reminder. This explainer is for educational purposes only. It is absolutely not investment advice, and you should never make financial decisions based solely on it. Every investor needs to do their own comprehensive research and seriously consider their own risk tolerance before investing in any company, especially one as complex and volatile as AppLovin. Thanks so much for joining me on this deep dive, and keep learning.